Ah, good evening, everyone. So, we started since yesterday on how to place trade, how to impute stop loss, and how to take profits. And I believe you all understood that concept. So, like today, okay, like I said, that today we'll be going into time frame analysis. But before we move into time frame analysis, let me just take you through some areas before going to that point so that you can understand what I'm actually talking about very clearly. Okay, on my chart now, you can see some white and black things up and down. So those white and black things, they are the one we call candlestick. I say again that we call them candlestick. The black and the white. We can also have green and red. You understand? It depends on any color you feel like picking. But if you feel like changing color to your own, you can just come to this three dots area, come to settings, just move down here. Let me say charts. No, not charts. Let me pick color customize. Okay. Bearish and bullish. This bearish, I can make my bearish to be red. Look at my bullish. I can make my bullish to be green. Then I say done. I move back to my candle. Can you see now that it has changed? Initially it was black and white, but now it is now what? Green and red. Now this red here you are seeing, the red, they are the bearish, meaning sell, while the green are the bullish, meaning buy. Do you understand that now? Okay, let's move a bit away from here before we come back again. Now I want to take you to where indicators are. Indicators like moving average, Ichimoku Kinko, stochastic oscillator. Let me just take you to where they are. You will see them. We have a lot of them. Click on that F you are seeing at the top, the F. Now look at them. Here are they. Can you see them? You can see them. We call them indicators. Now, before that we call them indicators, we want to make use of one this evening, which is moving average. That is where we'll be starting from. If you click on the moving average, first of all, before I move to the moving average, what do we use the moving average to do? We use moving average to catch trend. You understand? If a trend is about to form, let me say a trend like buying, whether the market wants to buy, how do you know that the market is about to buy? How do you know that the market is about to sell? We use moving average to catch that. Now let me take you to that point now. And okay, before that again, we have a lot of moving average analysis. Like we have the 20, we have the 10, we have 50, we have 100, we have 89, and we also have 200. Now, but nevertheless, you can make use of two moving average together. You can also make use of one single moving average. But anytime you are making use of two moving average, it means that you want to use it to trade crossover. How do I mean by that? That is, I will show you all this thing I'm saying. I will show you now, because I told you that this is a practical section, purely practical section. Now, when the first moving average crosses the second one and starts going up, it is indicating that what's called a buying trend is about to form. And when the other moving average too crosses the down one and coming down, it is telling you that a selling trend is forming, so you can enter into that market and sell. You understand? Now let's move into it one after the other. You can click on this moving average. Now on this moving average here, what are you seeing here? You are seeing what? 20. Am I correct? But let me start from the smallest to the biggest. And another thing I also need to tell you is that anytime you are making use of moving average, if you are making use of two moving average, one will be smaller than one. That is, one number will be smaller than the other number. Now the smaller number is the fast moving one, is the fast moving average, while the bigger number is the slow moving average. Hope you are getting what I'm saying now. Now for this 20 now, let's edit this 20 to 10. I want to edit it to 10. I put 10 there. I want to put my color to be red. This pixel, I want to change it to red. Look at it. I'll pick it to be red. Then I'll now click what? Done. Now can you see it now? Is the red line you are seeing on my what? On my candlestick. You know I called all this green red candlestick. So that's the moving average is the one you are seeing on my candlestick. And if you see them, it's directly on the what? The candlestick. Now I want to make use of two moving average to trade, the 10 moving average and the 20 moving average. Now what do I do again? I'll go and add the 20 moving average. You click on the F again. Don't forget I told you that is the area you go to add your moving average. You click on the F again. Now don't click on this moving average. If you click on this moving average, it means you want to edit the initial one you have added to your chart. Now go to that main chart, that F plus, click on the F plus and click on this moving average here. Moving average. Click on the moving average. Now edit this 10 to 20. So you can now change color for it now. Let me say you can pick blue. So done. Now can you see now that I'm having a color red, I'm also having color blue on the chart now. Is that taken? Now I want to put my phone on a landscape so that you can see it properly. I like putting my phone on landscape so that I can see the market very clearly. Is that taken? Now what do we use this them to trade? Now don't forget I told you that the smaller the number, the faster the moving average, and the bigger the number, the slower the moving average. Now the red here, can you see that the red is the fast moving average, while the blue is the what? The slow moving average. Now let me now give you the nugget there. Anytime the red moving average crosses the blue and going up, it is indicating that the market is buying. You can also put it this way: anytime the red moving average is above the blue, is indicating what? Buy. And anytime the red moving average, the red line, which is the red moving average, the 10 moving average, anytime is below the blue, it is indicating what? It's indicating sell. Okay, how true is that? Let me show it to you. Now look at it. Let me show it to you here. Now look at this point. This point. Can you see that the red moving average crosses the what? The blue and going up. And if you should watch, you are seeing more of what? Green than red. Am I correct? Green. Can you see that now? Okay. Let me show you. Look at something. Can you see? The more the red is still on the what? The blue. You are seeing more of green than red. Fine, you are saying red. What are those red doing there? Those red are just like retracements. The sellers too, they are trying to flex their muscle too. They want to collect the market from the buyers, but the buyers are stronger than the what? Than the sellers. That is why you are seeing those small red. Now watch here now. The point where the watch the point where the red here. The point where the red crosses the blue and coming down. What are you seeing? You are seeing more of red. Am I correct? The red going down, red going down. Hope you are getting me now. Like I said when the red moving average or when the fast moving average crosses the blue moving average and going up, the market is indicating that you should what? Buy. But when the red moving average, which is the fast moving average, crosses the blue and coming down, the market is telling you to do what? To sell. Let me show you other things again. I want to move the market back so that it's better. Now look at this area. I'm just trying to attest my point for you to see that, oh, this person is saying the truth. Look at it. What's happening? Please, sorry about that. Look at this area. Can you see this area? The what? Red moving average crosses the what? Blue and coming down. Can you see how the red is coming now? Red coming. So that is to say, anytime your fast moving average crosses your slow moving average and going up, it is indicating what? Buy. And anytime the fast moving average, which is your red, crosses your blue and coming down, it is indicating what? Sell. Now, what is the difference between the fast moving average and the slow moving average? The fast moving average reacts very quickly to what's it called, to the change in the market, or it reacts quickly to change in price, unlike the slow moving average. That is, when the market starts selling, the fast moving average will quickly tell you that the market has started selling so that you can enter into the market. But the slow moving average will not tell you on time until the market must have sold to a particular point before it tells you that, oh, now start what? Selling. Hope you are getting me. Now, does it mean that the fast moving average is better than the slow moving average? No, purely no. They both have their advantages and their disadvantages. Now let me give you their advantages and their disadvantages now. For the fast moving average, which is the red, fine, it quickly reacts to the price. When the market is telling you to sell, it starts showing you to sell immediately. But sometimes the sell may not be a real sell. It may just be a retracement. For example, let me show you something here. Look at this point. Okay. Look at this point. Here. Look at this point. The red is what? The red crosses, it will just be changing. You will know the right to this thing. Now look at it. The red crosses the what? Blue, and coming down as if it wants to what? It wants to sell. And before you know, this thing start moving up again. It is just a retracement that happened. That is why sometimes many traders, they don't follow the fast moving average, because they know that it's like it may be a fake. You understand? It may be a fake. But for the slow moving average, the slow moving average don't give you fake. It will make sure that the market must have been selling, or if it is buying, must have been buying to a certain level. It will assure you that, oh, it is truly buying, not a fake out. But the red one, the fast moving average, will immediately tell you, oh yeah, enter into the market, it has been buying. You just enter into the market and the market will not buy again, will not start selling. So it reacts very fast to price, but that is its own disadvantage. It may be a fake out. Now, what is the advantage of the fast moving average? The fast moving average is that the advantage is that if it tells you to buy at the initial stage and the market happens to be a buy one, oh, you are going to enjoy it. You are going to make a lot of profits. You understand? If it is not a fake out, you are going to make a lot of profits. Unlike the slow moving average that will tell you to buy later, when the market have been buying. So that means you would have lost a lot of pips which you're supposed to have gained when it has to do with the slow moving average. The slow moving average would have allowed the market to sell to a particular point before telling you to do what? To sell. Hope you are getting the gist now. So that is how to use moving average. Is that taken? That's how to use what? A crossover of a moving average. In summary, again, I said, when the fast moving average crosses the slow moving average and going up, buy. But when the fast moving average crosses the slow moving average and coming down, it is indicating what? It is indicating sell. Please, I want you to know that. So you can check that on your chart. Open your chart, add your moving average, the 10 and the 20, and move back. Okay, let me show you another thing. There's another thing I want to show you. Let me show you another thing. Let me show you something. Another thing I want to show you is okay, I'm on Euro USD, right? So let me go to let me say GBP USD to open chart. We want to see if what we saw there before was correct. Look at it. Can you see that it's the same thing? Can you see it? Look at this point. Look at this point here. when the fast moving average crosses the slow moving average and coming down, can you see that the market is selling? It's selling. And when the fast moving average started going what? Up again, start going towards the slow moving average, can you see that the market is what? Is buying. If you should trace back and move it back and back and back and back, you will see that what I'm saying is correct. Look at it. Just check back. You understand? On any currency pair, any currency pair you feel like picking, check it out. It can be on a New Zealand dollar and the USA, NZD. Just say open chart. Place it like this. You place it on the horizontal so that you can see the market very clearly. Can you see? Look at this point where the look at it. At this point where the fast moving average is going above the slow moving average. What are you saying? Still saying what? Buy, 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 buy. Can you see it? So that is how wonderful moving average is. Is that taken now? So let me take you to another concept before I call it a day. Let's check the time frame now. Okay. Now if you want to check on the time frame, how do you add your time frame? How do you do everything? Just click on this chart, just click on it. Can you see the time frame has come? Now if you should look at my chart up there, you will see that I'm on what? H4 means 4 hours time frame. But we have 1 minute time frame, 5 minute time frame, 15 minute time frame, 30 minute time frame, 1 hour time frame. D1 means 1 day, W1 means 1 week, MN means what? Month, and week and means month rather, month. Now, what is the advantage of all this time frame? Now, the advantage of all this time frame is 1 minute, 5 minutes, 15 minutes, 30 minutes. Those time frame, they are for scalpers. Who are the scalpers? Scalpers are the one who comes into the market. You just look at the market. Oh, this market will sell a bit now, and they enter into it with a very big lot size, and the thing will just sell small. They got their profit. They move away. You understand? Sharp, they move away. Now, but to me, I make use of H4 and H1 as a what's it called? As a swing trader, or a day. Let me say a day trader. You understand? Like as a day trader. As a day trader, I'm not a swing trader, I'm a day trader. Swing trader, they are the 1 week and a month. So now look at it. Anytime you notice, okay, before that, let me show you something. Now look at it. I'm on what? H4 now. Let me show you very clearly here. I'm on H4. I'm on H4. For the fact that I'm on H4, look at the market. The market ended where? Sell, which is the red, before the market closed since yesterday. Now let's check on 1 hour time frame and let's see what is happening here. Let me click on my H1. Okay, look at this one is H1 now. Can you see that this one did not end what? Sell. Ended what? Buy. It means that H4 was buying before the market closed, and H1 has started what? Buying. Abi? Now let's check another one. 30 minutes. 30 minutes too was what? I started what? Buying. This one has finished what? Selling. I started what? Buying before the what? Market closes. Now, what are the advantages that this time frame has? To me, I will advise you to use 1 hour and 4 hours. Like a friend of mine, a lady said, she does not use 30 minutes and the rest. She makes use of 4 hours. Meaning that, let me tell you the advantage of using a higher time frame. For a higher time frame, anytime you notice that there is going to be a buy signal on a higher time frame, that buy will last for a long time before it now begins to sell. Unlike small time frame, a small time frame may show you to buy now, before you know it reverses again. For example, let me click something. Let me show you something. If there's going to be a buy on a higher time frame, it's going to be like this. Buy. The buy will be very long. It can sell a bit and start buying again, sell a bit, start buying again, sell a bit, start buying again. You understand what I'm saying? But if it is on a small time frame, like 5 minutes, 15 minutes, and and 30 minutes, the thing will just go like this: buy, sell, 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 buy, sell. Can you see? Unlike this one has what, a very long buy, but this one small buy. So it's only people with a very big capital base that can make profit here. So don't try using 15 minutes, 30 minutes, and the rest. Don't try using them. But it doesn't mean that you should not use them. You can use them too. Anytime you notice a buy on a higher time frame, you can come to the lower time frame to check what are they also saying. Sometimes if your H4 is telling you to buy and H12 is saying you should buy, oh, it's a very strong signal. You understand? If two time frame are telling you to buy at the same time, or they are telling you to sell at the same time, they are what? A very strong signal. So that's just the importance of time frame. So sometimes you may open a trade, you may open your chart and you see that the market is buying on 30 minutes, and you now open 1 hour and the market is now selling. You now be saying, is it not the same currency pair I opened? Yes, it's the same currency pair, but they are working on the time frame of different time frame. One is working on 30 minutes and the other one is working on 1 hour. Is that taken out? Hope that is clearly. So if you have any question, you can ask me question. I'm going to answer all your questions. Is that taken?